We are covering the 5 methods of risk management for the property and casualty exam. These methods are crucial because nearly every exam will have questions that require you to identify which method is being used in a given scenario. The 5 methods are avoidance, retention, reduction, sharing, and transfer. A great way to remember them is with the mnemonic STARR: sharing, transfer, avoidance, reduction, and retention. Let's break down each one from an exam perspective. First is avoidance, which means completely eliminating the risk. If you want to avoid the risk of a car accident, you simply don't own or drive a car. On the exam, a question might describe a business that decides not to manufacture a hazardous product to prevent potential lawsuits. This is risk avoidance. Next is retention, which is accepting a risk and its financial consequences. This is when you essentially self-insure. The most common exam example of retention is a deductible. When you choose a $1,000 deductible on your auto policy, you are retaining the first $1,000 of any loss. A common exam trap is a scenario where a large corporation sets aside funds to pay for potential losses instead of buying insurance. This is a form of retention, not transfer. Third, we have reduction, also called mitigation. This involves taking steps to lower the frequency or severity of a loss, but not eliminate it entirely. Installing a sprinkler system in a warehouse is a perfect example of risk reduction. The sprinklers won't prevent a fire from starting, but they will significantly reduce the amount of damage. Other examples include installing burglar alarms or maintaining safety equipment. The fourth method is sharing. This is when a risk is distributed among a group of individuals or entities. Think of a group of small business owners who pool their money together to cover each other's losses. This is different from insurance, as it's a shared arrangement, not a contractual shifting of the entire financial risk to a third party. Finally, there is transfer. This is the entire basis of insurance. You transfer the risk of financial loss to an insurance company in exchange for a premium. When you buy a homeowner's policy, you are transferring the risk of your house burning down to the insurer. The exam will test this concept directly by asking you to identify the method used when someone purchases an insurance policy. The answer is always transfer. Be careful with trick questions that describe a scenario that sounds like insurance but is actually retention, such as a business that self-funds its own liability plan. That's just a formal way of retaining risk. True transfer involves a separate entity, the insurance company, assuming the risk. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.